accounts receivable turnover ratio. A receivables turnover is used in business accounting to quantify how well companies are managing the credit that they extend to their customers by evaluating how long it takes to collect the outstanding debt throughout the accounting period.
The account receivables ratio serves two critical business purposes. First is it enables the companies to understand how quickly payments are collected so that can pay their own bills strategically and plan future investments. Secondly, the ratio enables the companies to determine whether their credit policies and processes support good cash flow and continue the business grow or not. Account receivables turnover explained. Account receivables turnover ratio to achieve financial securities. A business is most understanding their account receivables turnover ratio, which is measured to efficiency of a cash flow. Unchecking and unmanaged account receivables turnover can lead to missing payment by causing financial problems. Ensuring a company's collect owned money beneficial for both internal and external financial engagement. The higher ratios of express potential investor or financial institution can make diligence in account receivables revenues indirect impact on the organizational bottom line. Account receivables turnover ratio is very dependent on the industry, but the highest ratio can make better expressions on potential investor or financial institution.
So now, let's move forward to how to calculate accounts receivable turnover and the formula to it. Calculating accounts receivable turnover, also known as the receivable turnover or debtors turnover ratio. The accounts receivable turnover ratio is an efficiency ratio, specifically an activity financial ratio, used in financial statement analysis. It measures how efficiently and quickly a company converts its account receivable into cash within a given accounting period. The accounts receivable turnover ratio is calculated by dividing net sales by average account receivables. Net sales is calculated as sales on credit, sales returns, sales allowances. Average account receivable is calculated as the sum of starting and ending receivables over a set period of time, generally monthly, quarterly, or annually, divided by 2. The formula for calculating the accounts receivable turnover rate for a year period looks like this. Accounts receivable turnover ratio is equal to net credit sales divided by average account receivable. On the next page, I will give example to how calculate the accounts receivable turnover. So, here comes the example. Flo's Flower Shop sells floral arrangements for corporate events and accept credits. The shop totaled 100,000 in gross sales. Starting accounts receivables for the year were $10,000. Ending accounts receivables for the year were $15,000. The formula for calculating how many times in that year Flo collected her average accounts receivables look like this. To calculate the account receivable turnover ratio for Flo's Flower Shop, first, calculate the average account receivable. Add up the opening account receivable, which is $10,000, and then the end of the year account receivable, which is $15,000, and then divide by 2 to get the average account receivable, $12,500 in this case. Next, plug your numbers to account receivable turnover ratio formula to take the net gross sales, 100,000, and then divide by the average account receivable, 12,500 to get of 8. To get the ratio in days, in order to know the average number of days it takes a client to pay on a credit sale, the formula looks like this. This number means the Flo's Flower Shop accounts receivable turnover 45.63 times in the past of 1 year.
So gigamit ni siya sa negosyo aron masukod unsa ka maayo ang kuan, unsa ka maayo ang company mo manage sa pagkuan, mo manage sa pag-credit sa iyang mga customers pinaagi sa pagtan-aw unsa kadugay ma-collect ang utang throughout the accounting period. For example, Chewy Baits Company supplies fish bait to stores at docks and marinas throughout the Southwest. The company invoices each of the stores once a month. Payment terms are the same for each customer, net 30, meaning payment is due 30 days after the invoice date. Some of the company's customers pay on time as agreed, but some pay late. A few may go out of business and not pay Joyce Bait Company anything at all, which would result in bad debt. By comparison, Lucky Luke Cable TV Company delivers cable TV, internet, and Volpe phone service to customers. All customers are billed a month in advance of service delivery, thereby preventing any customer from receiving services without paying the bill. In other words, its accounts receivable are better protected as service can be disconnected before further credit and extended to the customer. In both cases, the accounts receivable turnover ratio shows how long it takes customers to pay on average, and that information in turn reveals a lot about how financially stable the company is and how well its cash flow is managed. For example, Chewy Baits Company nagsupply og isda nga paningwit sa mga tindahan sa mga pantalan ug marina sa tibuok Southwest. Ang kumpanya nagpadala og kanang invoice sa matag tindahan usa ka bulan. Ang termino sa pagbayad parehas alang sa matag customer, net 30 nga magpasabot nga ang bayad kinahanglan ibayad sulod sa 3 kadlaw human sa pitsa sa invoice. Nay uban mobayad on time, naapoy uban late, naapoy uban di mamayad, which would result in bad debt. Sa pag-compare ang kumpanya sa Lucky Luke Cable TV, paghatag og cable TV, internet ug Volpe phone service ngadto sa mga customer. Tanan nga mga customer ginabayaran usa ka bulan sa usa ka serbisyo nga gihatag, aron maigo nga walay customer ang makadawat og serbisyo na wala mabayad sa bill. Sa laing mga pulong ang ilang mga accounts receivable mas maayo nga gipangamhaan kay mahimong i-disconnect ang serbisyo sa customer sa wala paghatag og dugong credit.